Comcast is the largest American multinational telecommunication conglomerate. Right? It is the second largest broadcasting and cable TV company in the world by revenue. Right? So areas of business. First of all, like cable communication comes to 54% of the business. So it's high-speed internet, pay TV, voice services. And it's traded at the Xfinity brand. Then NBC Universe, 29%. So it includes broadcast, cable, and streaming networks. And then they also 17% is covered by these two segments, TV film studios, so it's Universal Pictures and DreamWorks, and also theme parks, Universal Studios. Actually, in my life, I visited Universal Studio twice. I've never been to Disneyland, but I was twice in Universal Studio, once in Madrid and once in Orlando. Okay, and here I put some pictures for you to see what kind of services they provide. Now, if you want to read more about this business, you can go to Wikipedia. Very good information, mostly historical what they do. You know, so just to understand how they structure their business and so where they came from. Just a second, okay. And if you want to go to financial reports of the business and listen to their podcast, I definitely recommend to go to corporate Comcast.com. When you're looking at this particular information, so you probably understand that when the crisis hits, okay, when the recession hits, people less likely going to switch from subscriptions, because if they lost their job, I don't think they're going to disconnect Disney at the same time, and Disney and all this subscription, because they're sitting at home anyway, so they want to watch movies, and the cost of some subscription is $10 to $15. Sometimes it's less even, right? And of course, what's the point for them to, like, I mean, save $10 and then to have nothing to watch, right? So majority of people, they stay in that particular business in any way. So sometimes they even add more subscriptions, like happened during the pandemic with COVID. So majority of these businesses, they actually improve their performance, improve their level of sales. But at the same time, if we look at the last particular, like, I mean, not recession, but I mean, problem with the coronavirus, we noticed that there was quarantine, and TV and film studios, they couldn't work, right? So they had a limitation on that, and also theme parks, they were closed. So that's why Comcast, their loss, like their revenue went down because of that in 2020, right? Similar to Disney. So Disney has exactly the same issues. Now, let's have a look at the value line. Then you can see the first line, revenue per share. But before that, probably what we do, timeliness 2. Remember that value line gives us information that timeliness 1 is the best, so it has the highest potential to grow within the next 12 months. And it's only 100 companies out of 1,700 companies, right? Timeliness 2 is assigned to 300 companies. So it's like also the best out of 1,700. So it has a second highest potential for growth within the next 12 months. Safety is 1, so it's the best. Technical 5, because it's kind of a downturn. Now, beta is less than 1. So some people believe that it's good when it is 1, because it's kind of reflects the, let's say, index movement. Some people believe that it's much better, especially when the unknowns, a lot of unknowns in the market, and people are afraid that the company can go down. So they prefer that beta is lower. So it means that if the market goes by 10%, this company will go by 8%. So it's like only 80% of the movement of the market. Okay, so something like that. Dividends, 2.4%. So this is not a huge dividend. But at the same time, if we look at PE ratio here is 12, but the report was done a month ago, and at the moment the share price is $38. So it's $6 less. It's about 15% lower than the current price. So it means that the PE ratio is lower as well. Okay, so close to 10 something, 11. All right. So, and relative PE ratio is 0.74. What it means that 1 is average on the market, 74 is lower than universe in like value line universe. And we just spoke about indexes, and I showed you that P/E ratio for Standard & Poor is 18, and P/E ratio for Dow Jones 18, and Standard & Poor 22, and Nasdaq is 26. So definitely P/E ratio 12 at a very low scale of the business. Okay, so the company is priced much lower than in average the whole index. Now let's have a look at sales level. That's what we see: $2.6 in 2006 and $27 in 2022. Their plan today. So it's like 10 times. Fantastic growth. Now, if we look at it's consistent growth, right? All the time. Even in 2009, we can see that the company grew. Okay, so no slowdown here until 2020. So $23.9 in sales, and then $22.6. So we lost $1.3 here in sales, about 5%. And after that, we recovered. In 2021, we showed already better results than expected. Okay, so we can see the growth even from the 2019. So this year they're planning to close $27. 60 cents in revenue, okay, and in 3 to 5 years, $35. So they project the growth to continue. Now, if we look at earnings, earnings from 23 cents went to $3.6, even more than the sales, so more than 10 times, 15 times practically. And also, if we pay attention to 2008 and 9, we can see that during that tough time when all businesses were collapsing, right? The company was actually growing 50% annually, right? So then it was a bit slowed down in 2009, 2006, but still growth, right? And after that, it's continued until 2019, 2020. In 2020, we had this drop, okay, of what, 70 cents here, so about 20% drop in earnings. But after that, we recovered pretty quickly, even higher than 2019, and start working pretty well. So the company is very stable. The only, like, if we take this 15 years of reports, we can see only 1 year when the company had a slight like reduction in their sales and earnings. Okay, this is a good thing. Now, if we look at book value, we can see here growing from $4 to $22. But in reality, it's all like, if you look at tangible book value, it will be negative. The company, the business structure is very different from a lot of other businesses. So you understand that when they grow, actually, Comcast, they grow by acquiring another smaller businesses. And when I acquire them, there is a lot of goodwill, it's first of all. But also when they, even if in the normal line of their business, they have to buy certain licenses or patents or rights to show certain movies or use certain characters, right? And of course, there is a huge level of intangible assets on their balance sheet. And as a result, if you look, I'll show you later, but the tangible book value is negative, minus 17 actually, right? So you have to take it into consideration. If you look at common shares outstanding, you will see that, for example, here they have 5.4 million shares, but in any way, so here 9 million shares, and constantly buying it back, constantly. You can see that last year it was, in 2020, it was 4,580,000, then 4,530,000, and this year they are planning 4,445, right? So 4,445,000, yes, and then continue to buy. So they constantly buy their share, which is also a pretty good sign. So they believe in their own business. All right. From the income tracks, net profit margin is improving. So we can see it was 10%, 9% here, and now it's close to 13%, and they're planning to have 14 and 14.6. So it's a good sign. It means they have become more efficient and effective in their business. It's kind of good. Long-term debt is pretty high. So the total debt is $99 billion. And the capitalization of the company on that price was 198 billion. So it's more than half, 50% in debt. So that is very, very good. We need to evaluate if the company can pay their debt or not. So we can see that currently net profit is around $16 billion. Next year going to be 17, and then planning to go to 21. So even if with the $16 billion in profit, so if they decide to pay all their money to cover their debt, it's about 6+ years, 6.5 years for them to cover their debt completely. So it's not that bad, and especially if you pay attention to the cash flow and notice that cash flow, it's actually like twice as high as the earnings. So for example, if the earnings last year was $3.2 and cash flow positive was $5.8. So what's on the top of that, about 80%. So I presume if they have net profit $15 billion here, so it would be around $25 billion in cash. So they're receiving in cash. So they can utilize the cash. Usually they spend this cash to buy other businesses and paying a bit of dividends and buying back common shares. So it's we can understand that if they decide to pay the debt, they can pay it. Now, one of the reasons why the share price went from like $61 last year to the current price of $38, I personally believe is that people worry because when investors assess the company and they see this level of debt, they kind of become worried because the interest rate is increased, like, and Feds keep increasing it. So can you imagine that if the company paid, assuming like 3% only in the, like, I mean, interest rate. So from that level, that would be about $3 billion. So during last couple of quarters, they increased it, right? So can you imagine if even 1% was increased to 4%, assuming they're paying. So it's already one additional $1 billion. So if they increased 2% in interest rate, so it's $2 billion for them to pay. And it means that out of 16 billion or $15 billion of their profit, they have to lose $2 billion for that particular expense level, right? So, and it affects nearly 10% in profitability of the company. So that's why people, personally, I believe, start selling it off. Also, there is a fear on the market in general, and everything goes down regardless of the company. So it keeps going down. And also, it was overvalued at the highest peak of when it was $61. So these are the main reasons, because fundamentally the company is strong, it's keep growing, right? Keep selling more products, keep receiving higher profit. But the expectations and fear on the market, that's what affected the price fall. Okay, now another thing which we need to pay attention to is the working capital. It is negative, and it's negative since 2013, so last 9 years. And a lot of people think, oh, it is kind of a bad thing. So, but what I want to show you, probably next page, is that current assets, they have $25 billion, they have $8 billion in cash, and they have quite a lot of current liabilities, so much higher level, right, $4 billion more. So, and a lot of people say, oh, it's a very difficult and dangerous situation to be in. But I want to tell you the way these businesses operate and the way the accounting works for them. So when you get money, let's say first day of the month, and the company receives your subscription payment for the next 3 months, right? So the money hit the account. So actually, it's not the sales yet, okay? So they have to provide you service first. So when you transfer the money to the company for electricity, for insurance, for something like that, it's not instantly becomes their profit, right? Because until they provide the service for you, it's shown there as a just debt. They owe you company. So if you cancel the subscription, or if you cancel your insurance, in case of insurance company, they have to pay this money back. Okay, so, and until they provide the service, they cannot convert it to non-sales. So that's why if you look at the items here, other, right? And other is pretty big there, $14 billion. So personally, I believe, of course, you have to look at more details in the balance sheet and break down if you go to balance sheet on the website of the company. But understanding the structure of the business, I can easily assume that this money is what they received from the like subscribers, but they haven't yet converted into sales, right? So these are not debtors, and they're not going to come to you and like request this money. Okay, so that's why I personally believe that this situation is not dangerous in this particular case. Now let's have a look at annual rates of growth. We can see that if we take an average last 10 years, the growth rate in revenue was 12% and 16% in earnings. Fantastic. It's a very good growth rate for the company of this size. Now, if we look at the last 5 years, we can see it slowed down. Okay, it's 9.5% and 13%. Okay, relatively. And if we look at their projections, so they have 6.5% for earnings, for sales, sorry, and 9.5% for earnings. But there is a small thing, and they have earnings predictability of 90%. So 9 out of 10 times they're right, okay, in their case. Now, and if we go further, I'm going to show you a bit later in estimates and probably tell you right now. So they usually, if they are wrong, they're wrong on a higher level. So they underestimate their performance and usually overperform, right? So this one time when they're wrong, they're actually wrong in it. Which is better for us. Okay, in this particular case. Now, and here you can see that constantly making money. We didn't have even one quarter no one losing money, and also we can see that dividends are increased every year. Okay, so this is a dividend strong company. Even the dividends are not that high, but they constantly increase their dividend rate. Stock price stability is 100%. Persistence of growth 85%, and financial strength is A, right? And recent quotation, we think that buy and hold investors will also do well here. To that point, the midpoint of our 3 to 5 year target price range implies double-digit average annual returns on 2025-2027. Okay, so Valueline has very good projection for this company, and as you can see, 18-month projection between 40 and 71, and the current price is 38. So actually, it's only go up. And if we look at the 3 to 5 year projection, so we can see that they expect the company is going to be between 80 and 95. So this is $44 price was at that time. So, but currently it's 38. So it's more than 100% on a low scale. Right, and about 150% on a higher scale level. So this is a Valueline projection. And another good thing also, let's have a look at P ratio, right, in order to analyze it. Now, if we go back 2006, it was 47. It was the highest point in P ratio, then 34, then slowed down, and the lowest P ratio was in 2009. Okay, and we already noticed that actually they increased their sales level, they increased their earnings during that time, but the price still collapsed, and we're going to see it when I'm going to analyze company technically. So it means that people were selling off the company while the company was growing, and that's why the P ratio at that time, and that was the only year in the middle of the crisis when P ratio was 11.8, and now it's even lower. Okay, than that. So if you calculate it, because this P ratio has to be adjusted here. And after that, we can see that P ratio was 14, 14, 14, 16, right? So average 14, then 16, 18, 18, 18, 18, right? So it's average. So it means during the same year, it could be 20 and could be 16, right? And then we can see a bit slower down. So 13 in 2019 and 16 here, 17, and at the moment it's at a lower scale.